Well, hello, everyone, and welcome. This is Cynthia Tamain with Interactive Brokers, and thank you for joining today's webinar on major junctions ahead for energy, grains, and metals. Now, we're very pleased to have David Hightower with the Hightower Report to deliver today's presentation. As the founding principal of the Hightower Report, Dave Hightower analyzes energy, metal, index, currency, and bond markets daily. And for the with 30 years of experience in the commodity and financial futures industry, please join me in welcoming Dave Hightower to today's session. So Dave, thanks for joining us. I'm going to go ahead and let me actually give you the controls. If you could share your screen, we'll go ahead and get underway here this afternoon. Thanks for joining us, Dave.
Good to be here today. A little bit of a correction here on I'm now 36 years in the business. Time flies when you're having fun. Over the past 3 years, I have been to 37 countries, giving speeches and presenting opinions on the commodity markets. The focus on and requests on those presentations has now increased dramatically from Southeast Asia and Eastern Europe, and that's indicative of where commodity demand is due to come from, where it is surging. Southeast Asia alone approaching 900 million people. And so it's important to realize that that's the shape of things to come, and that's a major impact on commodity demand and to a lesser degree on commodity supply. The Hightower Report has the most widely distributed daily research package on Earth, read by some 5,000 people globally. And we do look at all actively traded commodity markets, and the importance of that is that markets have become interactive. They are no longer isolated among their own fundamentals, and it's a hard grind every day to go through and do the legwork to find out what has happened overnight, what's important of those developments that have taken place, and then what kind of posture are the particular markets impacted by that currently in position for. As you can see, the first slide here, very negative track in commodity prices last year. I would suggest that a lot of negative psychology was thrown into commodity prices, along with equities and consumer psychology, because of the culmination of several big picture negatives, and that was primarily the fear that rates might be hiked too much, fear that tariffs were going to result in an all-out trade war, ideas that the exit situation would derail Europe, fears that the U.S. government shutdown would also add to the turmoil, and if you want to look at it this way, even some ideas that perhaps the holiday sales period was not as robust as hoped, and therefore casual or just on its own slowing was possibly hitting the equation. So again, we like to look at a big picture macroeconomic view, because commodities have their own ebb and flow, and the outside markets tend to accentuate the internal fundamentals. So if we're a bearish grain market and you have a bearish economic view, that adds additional downside momentum to the market. But as you can see, my job as an analyst is to, one, recognize what trends are, but also when you have such an established trend, we need to be on the lookout for when that might be coming to an end. And so I look back and I find a little bit of overdone psychology. Next slide shows you how I calculate the net speculative positioning in commodities. So this is 20 non-financial markets. It's a positioning report that's calculated every Tuesday, released on Friday from the Commodity Futures Trading Commission. and I look at options and futures, and I look at only those accounts that have the ability to be long or short, meaning they are speculative, not hedgers, not commercial users. They have a opinion that they can put in place with positions. And so this is kind of at the very peak of this chart. If you look at the high that we had on this chart at some point in early 2017, that would be the maximum speculative bullishness that we've seen through the life of this chart. And if you go all the way back into 1999, you see where the speculative interest was at its most negative on the combination of all these commodities. So if you fast forward, look at today's current action, and this is a little bit old here, but probably one can say that we are near the bottom of the last 6 to 8 years type of psychology toward commodities. Well, the major market issues I think you should consider. So global sentiment was ruptured by trade, as we indicated. It should be saved by trade solution, but as is usually the case, the market long anticipates a repair of the situation. It takes longer than expected, and so the final influence is not nearly as accentuated or as prominent as one might expect it to be. So if we had higher tariffs, I think that's inflationary. If you have lower tariffs, that's really stimulative to growth. Now think about this. You may not believe that we will come out of this particular trade wave with no tariffs, but I think in the end result, we will find out that tariffs throughout the world are going to see a downward pressure. And so that's like a global stimulus if in fact it is actually unfolds. And so don't be surprised if the US president opens up yet another trade front with trade conflict with the Eurozone, because that's part of his objective, I believe. The next item is, if you have these tariffs and you are purchasing commodities from a more expensive location because of the trade conflict, that's a problem. And Chinese crude oil purchases from Brent crude oil sources, because of the attempt to avoid U.S. purchases, meant at times last year China was paying $9 per barrel more than they would have if they would have purchased that oil from the U.S. And making that point is, we had a similar situation with soybeans. We've had a similar situation with ethanol. We've had a similar situation with soybean oil, natural gas, and so on. A lot of this U.S. supply was actually exported to those intermediaries and then ultimately shipped into China. So if everyone adds their costs and profits to the equation, plus the adjustment for tariffs, and you have quite a bit of pressure on China. So it is clearly in their best interest to settle the situation. Last week, I just returned from Vietnam, where there is a palatable fear in the air regarding the African swine fever. There's also, I might add, that there have been some fresh concerns about army worms that could eat into cotton, that could eat into sugar cane, and really has an appetite for corn if it gets into those areas. I saw a lot of problems in India. That's a side note, because the African swine fever is the commodity story of 2019. We've had over 1 million hogs killed and liquidated. We have both Vietnam and China that are aggressively trying to contain the situation, and maybe are not doing as good of a job as is necessary. So this could result in, what it has resulted in already, is a massive amount of protein supply thrown onto the market in China, a somewhat of a temporary halt in their feed import needs, And what that will eventually result in our opinion, is a tremendous bounce back in need for the import of pork. Once they begin to try and rebuild their herd, they'll have to hold back animals for breeding stock. So what you lose in demand, you regain later this year. I do believe the dollar maximum bull condition is already passed, because we had the expectation of a number of dot plot rate hikes this year. And may see this afternoon, after we're finished with this conference, may see a Fed indicating only one rate hike, or maybe even no rate hikes for the rest of 2019. And so the dollar is lifted by the hope for higher interest rates here than elsewhere. It's also lifted by ideas that U.S. growth here will be stronger than elsewhere. And lastly, it's lifted by safe haven ebb and flow. And right now, I think all three of those factors are in the favor of the bear camp and the dollar. In the grain markets, I believe that the low in a market is made in the face of the period of highest supply. What's the highest supply? How do you know what the highest supply is? Well, I think you're getting close to the period of highest supply when you assume, as we did for most of last fall, that we were going to have a record crop. You also look forward into the next crop cycle in South America and assume a large crop. And now we're into the cycle here again this year, where 2 to 3 weeks ago, we were expecting large crop acres and still expecting those trend yields to rise. So when you're reaching forward, not only embracing the current unbelievably historically high levels of soybean stocks, but when you're projecting forward and expecting that to extend in another crop cycle, I think the bearishness has kind of reached an extreme, and therefore it could take very little in the way of some kind of crop issue in order to catch the market leaning too much in the negative posture. Another item that I saw in a trip to, I was in Malaysia also in the last week, and several months ago I was in Indonesia. They are making major changes there, in which they're going to mandate a certain percentage of diesel be biodiesel, and the use of palm to make that diesel. China, significant effort to clean their air, whether it's idling industrial complexes in the winter, whether it is shifting away from coal to natural gas, whether it's beginning to try and input ethanol into their equation. It is an all-out effort, and I must say it's necessary. It's badly needed and will be complied with. And the most important thing from this, other than the natural gas consumption they're going to see, is that they ramped up and said 2 years ago that they would have very lofty ethanol requirements by 2020. They want to implement aggressively ethanol into their equation. Now, they do make ethanol from cassava and other feedstocks besides corn, but just to meet that new ethanol production, if they were to use it all from corn, that would basically use 2/3 of what the available corn supply it currently sits at from the U.S. So that's a fresh demand need that'll have to be satiated as we go into the future. So not an insignificant development. I always like to add one idea. The energy markets are large, and the grain markets are very small comparatively when it comes to the impact of a little bit of energy demand on grain supply. So just keep that in mind. Also, we're going to see some commodity substitutions this year. And by that, I mean, you may see platinum start to gain on palladium. You may see silver start to gain on the gold market. You're going to see soybean oil begin to replace recycled oil when it comes to domestic biodiesel production. And again, keep in mind, energy markets are large, grain markets are small, and I will touch base on that a little bit later. So my view is that the economic outlook is not what we want, but it will be positive. You will see some resiliency in the economy once we realize. I think we will get a revision in that last non-farm payroll reading. It was influenced by the government shutdown and the delay in reopening the government. The trade war also continued to hurt that particular development. So I don't think it's a real high probability, but I think it's likely that you will see an upward revision, and that's a very important inflection point. I do think that we will rid ourselves, whether it'll be next week or the following week, that the Chinese situation will be resolved. Not all of the issues, but for all intent and purposes in the commodity markets, and maybe even for the equity markets, if you can get a large Chinese commitment to purchase agricultural commodities and oil and natural gas going forward, then really the severity of the trade threat will be lifted off the back of the equity markets. We do not expect to see a solution to the thorny issues of copyright protection and other items. But again, I do expect Chinese protein demand to recover. If there is a notable decline in Chinese pork supply, it's a mainstay of their economy. Of their diet, I should say. It's a mainstay of those that are prosperous and seeing a better life. A middle class and higher standard of living entails eating pork. And so that's something that is going to be significant going forward. And I do have some comments on what that impact will be. So in the renewed focus on the biofuels is not only limited to China. As I indicated, both Indonesia and Malaysia, Brazil, Argentina are now requiring additional biofuel use. So while biofuels have been around for a long time, decades, I think it's a renaissance or a revitalization of that argument. In the gold market, I think we're going to have a bullish shift in classic fundamentals this year. We see central bank buyers coming out of in very consistent patterns. We're now beginning to see derivative ETF investment flows. The gold market has been long ignoring the fact that production in South Africa continues to decline, and we have severe electric generating problems in South Africa right now with the major Eskom is the major electric utility, and they're running at significantly half of their capacity, and there may be debt failures in that company, which in turn may begin to shut the power off to both gold and platinum mining facilities. So a long-term shift, and again, for the gold bugs, that does not mean one of those big flash higher runs that you usually get off of a crisis or inflation. That means, in my mind, maybe an uptrend in the gold market. In the end, where's the oil market going? I have some feelings that U.S. production has continued to explode, but yet U.S. supplies have not built up. And so as a result of that, that tells me that there is demand, whether it's domestic demand or export demand, that is taking the newfound additive or surplus oil from the U.S. and it's being dissipated around the world. So a very upbeat view. So here's the next look. Here's your crude production. Very consistent, increased by 2.5 million barrels per day over the last several years. But the next slide shows stocks have not gone up. So U.S. production up by 3 million barrels per day. U.S. exports up 3.4 million barrels per day. So we're using it, and it's going to primarily to places like China and to a lesser degree into India. Next slide. We do have a lot of threats against production outside of the U.S./OPEC Middle East type of producers. That's something that's going to be difficult to rid ourselves of. This is a refinery operating chart here you see. So this is how much the demand for crude oil in the U.S. is. And as you can see, we're at very low levels. Which certainly is a little bearish to the crude oil market in the short term because we just don't have the intake of crude that we normally do. But yet, Despite this, crude oil has managed a $15 per barrel rally off of the late 2018 lows. And now we should see the refinery operating rate plus demand for gasoline begin to pick up. And so I think that the $55 level in crude oil is a solid value zone. The crude oil speculative positioning is only half of what the record spec long is, so the market is not short on buying fuel. It should also be noted that in some instances, crude prices below $55 a barrel, it's difficult to make money on some of the more expensive tar sands oil. And so that could be why we rejected that sub $55 level, because you could lose some production if prices maintain down in that range that we saw from November through early February. The next one, slide, again, natural gas has been dramatically oversupplied. You might say that it was the most oversupplied physical commodity of the last decade. But some changes have been taking place. The export capacity of the U.S., if you look 5-6 years ago, you'd had one export terminal at the Sabine Pass run by Chenery. Now you see applications and expansion of terminals taking place in an aggressive fashion. At the same time, when we go through and look at the weekly natural gas inventory statistics, about a year and a half ago, we shifted into a situation where inventories began to run under the prior year, and now we've settled into a 15 to 20% under the 5-year average natural gas stocks levels. So we've cleaned up the natural gas, sorry for the pun, because China is going to clean up by following through on their no new coal facilities mandate. And that's why natural gas is going to be included in part of the purchases that China agrees to make from the U.S. Here's the chart of natural gas. And now we're seeing, if you can see from that chart, that we are at the tightest. You look at last year, we ran below the prior 3 years, now we're running below the prior 4 years. If we had a 2014 year chart on there, we'd also see that we're at below for the last 6 years. So that $2 price level in the natural gas market was rejected as too cheap. We do have some offshore deep rigs that are pricing at $2.30, $2.40 as their cost of production. So like the crude oil market, you can lose some production if you're going to send prices back down below where they were last September. So the grain markets, shifting into them, we are now back into the beginning of the planting season, and we have a little bit of uncertainty being thrown into the equation because of excess flooding and wet soils and even some cool temperatures. But as I talked about in the beginning, we've seen the period of highest supply. The market assumed all these factors that I have there up above. But now at the bottom, we've got these surprise demand elements that are taking place. Biodiesel paramount because of the soybean oil situation. Hog liquidation tempers near-term demand, but the ethanol use is ramping up. And as you can see from that reading, the market has seen about 1.1 billion of added consumption of corn if in fact China reaches those figures. So a lot of surprise demand issues, and if we get a little bit of a demand issue, that could really have a noted impact on the market. Next look here is the Chinese net importing of corn. I got to give you some background. Over the last 2 years, China found significant amounts of corn. Now, by that, I mean they posted to the world that they had what amounted to 50% of the world's available supply of corn inside their country. And subsequently, the market did not believe this in the beginning, but the quality of that corn was barely usable. The quantity of it was much smaller, therefore, than what they had touted. And yet I look at this import chart, net imports into China. Why would you be an importer of corn if you had a surplus strategic reserve and claim to have half of the world's supply? So that doesn't mesh with me. So I don't think they had what they thought they had. And as you can see from the other chart, that domestic usage just continues to rise. That's a trend, and it's not going to stop, in our opinion. So we going forward, so you have a dramatically negative soybean situation, but in the corn market, it's the opposite. We have a tight condition if you look at not just how much we have, but how quickly we're using it. And you see that we are been running tight for a long time in the corn market. And if there is a planting delay, and if it's a big enough delay that some corn acres have to be put into soybean acres, which can happen, it's early for that. But if that does happen, it'll tighten the balance sheet. Here's the balance sheet. If we only have 2 million acres higher, and again, we're supposed to get higher corn acres because the soybean fundamentals are so negative that farmers are afraid to plant soybeans. But if we only have 2 million acres that are put forth, you can see at the bottom, the stocks use ratio is going to remain very tight in the corn market. And subsequently, the lows that we made last September, and probably even the lows we made this month in corn, I think are going to be strong value. Here we are. We want to talk ethanol just a little bit. Again, these other countries, Indonesia, Malaysia, I was talking before about biodiesel and palm oil, but now I'm talking about ethanol. And what happened here is China went out, bought some ethanol from countries that do not make ethanol. They bought it from us, shipped it to China, and China did this and paid up for it. They also did it in small, insignificant amounts, which tells me it wasn't worth the trouble. But I think what they were doing is that they were priming their domestic marketing channels, distribution channels, for the ramping up of ethanol use. So that on the ground, that shows me they continue to do it. Here's the biodiesel. Again, Indonesia, Malaysia, Brazil, Argentina, some of these are 10 and 20%. The reason this is, it is important when it comes to the world oil, vegetable oil type of consumption. This is a palm oil export chart, and you see Indonesia and Malaysia significant exporters of palm oil. But what really is the case is these three countries virtually export all of their production because they have very limited consumption inside the country. But here's a question for you. What's the fourth largest population country in the world? Surprisingly, the answer is Malaysia. So their mandate to begin to use a portion of their palm for domestic energy use means that palm will not be available for edible consumption. If I go back to this chart, I want to note something that's not showing up on this chart, and it's that the amount of palm oil production dwarfs, it's 7 times as much as the output of soybean oil. If you saw a 10% reduction in palm production or supply, if it's being used for something else, the rest of the edible oil markets, peanut oil, sunflower oil, canola oil, on and on and on, they could not make up that shortfall. So palm oil has become the major dominating vegetable oil market impact. And if we begin to use that for fuel, the commensurate impact on soybean oil is going to be significant. So using biofuels kind of like having an El Nino type of impact. The next slide here shows the world soybean oil ending stocks use ratio. So as opposed to beans, where the supply is historically oversupplied, record stock levels. We see stocks to usage ratios in the oil market, soybean oil, as tight relative to history. In the world, is really much more important than the U.S. And I would say that in a lot of different scenarios. U.S. and Europe are not going to matter as much as Southeast Asia and Eastern Europe, which, by the way, I've also had a lot of requests for presentations in Eastern Europe. That's another highly fluid and active area, particularly with economies, but they are beginning to get their modernization efforts in swing over there. Next, so in the near term, the market personality for the soybean market, in a weak El Nino in 2015, oil saw a significant, that is, soybean oil saw a significant reaction. And again, I'm splitting hairs here on the El Nino analysis. It's not a clear-cut correlation to what goes on in El Nino and what happens in North American growing regions, but there is a little bit more of a potential linkage when it comes to Southeast Asia and sugar and coffee and cocoa. Watch those markets. They may be a better early warning sign of some kind of El Nino impact. But we see a change in those zones 3 and 4, not in 1 and 2. That means not by the coast of South America, but out in the far western part of the Pacific. We're seeing less wind shear, and that means that tropical storms will be allowed to strengthen and not knock down. When you have a high level winds and you have wind shear, you can take the top off these typhoons and therefore kill the storm, so to speak. But with that, we're already seeing severe droughts in Singapore, Australia. In the past, when we've had El Ninos, you should be looking for severe fires in Australia. So I don't like to predict a weather impact, but I do like to say that given where the prices have been and given the speculative positioning and the biodiesel impact on soybeans and the ethanol impact on corn, it would not take much of a impact on the regions. And again, if we see a lot of typhoons blow into southern China, there have been a pattern of significant flooding. So it's south of the line in Singapore and into Australia, it's dry. North of that line, it can be overly wet. In the soybean oil market, the volume prior to the subprime crisis, 434,000 contracts of soybean oil, and now in 2019 we have 3.1 million. So the world is opening up to additional vegetable oil demand, and even one of the smaller veg oil markets compared to palm is seeing a significant change. Even open interest has jumped up. So we're going to have significant volatility in the soybean market in the coming months. And that should be a watch point here. Corn will probably be somewhat held back if soybeans are significantly weak. But if we do have other wet patterns line up behind what we now have from this date, 10 days out, we still see some precip, and we still have not had a full snow melt. So some of these river floods are going to continue to go up. And so volatility in soybeans and corn will be quite high. I think there's a lot of value in the corn market, very close to the market, and perhaps maybe not within 40 cents in soybeans, and maybe not even 60 cents if you were to get some kind of negative macroeconomic condition unfolding in the next 60 days. In the hog market, as I said, China initially said we got a case or two, but now we've killed over a million. Concerns are being covered up, as is usually the case. There are other large herds that are out there. Taiwan and Vietnam are extremely nervous about this. We even had a infected hog wash up dead in Taiwan from mainland China. So we're going to start over with this breeding stock. U.S. production from the first quarter to the second quarter, and from the second quarter to the third quarter is projected to go down. So a lot of reduced pork production, and that's going to catch up to the market later on. Vietnam, the Philippines, and Thailand are all trying to take the extra precaution of reducing their herds. And this has become so bad that Chinese feed mills are trying to diversify into other feed products. So it's a very significant development. One thing that I would suggest is that if you look at past similar African swine fever outbreak in Russia, they had similar difficulty to. They are much more government, what would I say, regional government control stepped in very quickly there, but yet they still had an ability to control this because of wild feral hogs and maybe even some bird transmission. They weren't sure, but we would project a similar problem resulting in about a 16% reduction in the total Chinese hog herd. And if that happens, that means that all of the rest of the world exporters of pork will have to double their exports. So it doesn't take a lot of math to realize that this could, what's a negative right now for the U.S., Poland, Canada, and others, could be a dramatically positive thing as we move through the year. The next slide, again, I like to throw out big picture things every once in a while just because you have to keep your eye out for big trends. And if we have a tremendously negative large crop, soybean crop washout in this crop year, and soybean meal prices continue to come under pressure because of what's going on in China, this particular relationship of fish meal prices compared to soybean meal prices, historically, we've seen times where fish meal was 15 times more expensive than soybean meal. And what's different this time around is that the diet, the science of the diet has now been proven to the aquaculture people that it can be used without weight loss and detrimental impacts on their production. I might also add that fish meal is not sustainable. Fish meal, when thrown into these floating cages of fish farmers, they sink dramatically, accumulate on the bottom and kill the bottom and ruin the oxygenation in the water, whereas soybean meal actually floats, and so therefore it's more efficient. Recently, fish meal is $1,000 per ton more than soybean meal, and since 2017, we've seen salmon feed by fish meal decline by 17%. So if we were to get a dramatic divergence with El Nino and low soybean meal prices due to excess supply, this could have the effect of a major transition in an industry like aquaculture. Moving on a little bit into the gold market now, as I said, the central bank gold buying trend has returned. Yesterday we saw 5 out of 7 countries reporting net purchases. As you can see, we've already begun a significant recovery from back following the subprime crisis. But I would suggest that 2 things are different now. Number one, China is hiding fairly well what they're buying for their reserves, but they had at last count, which I think in no way is accurate, they had 1,800 to 2,000 tons of gold. By the way, the U.S. has over 8,000 tons of gold. China 2 years ago came out and added the import facilities in 3 other cities besides Hong Kong. I think that they felt like they wanted to be able to hide their imports of gold or confuse the world market by adding those, because you pretty much knew what was going into Hong Kong was probably going right into China, but now they've made a little bit more difficult to understand. And the reason I bring that up is not just because China has shown the ability to buy 2 years of supply of cotton, sugar, corn, soybeans. They have also made a commitment to become a major world money center bank, and they want to have their currency be a reserve currency at some point. So they got a long way to go to rival the U.S. in terms of having their currency backed up by gold. And so I think that buying is taking place behind the scenes. The next item is the gold derivative holdings tally here. Again, you haven't necessarily seen a major upward adjustment in this number, but we watch that every day in our comments and are beginning to see and you could argue that by the time the ETF holders begin to step up in an aggressive fashion, that maybe the small traders or the bag holders or the run has already materialized. But we're going to be watching these statistics closely. And as the gold market transitions and the Fed remains on hold, I think you're going to see consistent investment flow come in to the gold market going forward. The copper market, again, here's another base metal that many attach significance to in predicting the world and in particularly the Chinese economic condition. But if we were to look at all the combined exchanges, you can actually go back and back into that January low in these combination of world copper exchange stocks. Those were near 10-year lows. And so here's a market that I believe is notably undervalued. It is mirroring the action in the zinc market, which is tight and is an industrial metal and is in strong demand inside China. Copper is a major component of those electric vehicles and even some of the battery technology. And part of the Chinese stimulus effort is for a dramatic expansion and upgrade in their electric grid. So copper currently sitting around $2.91. If you go back and look at 2 years ago, we had a copper market that was at $3 to $3.25. So I believe the copper market is a little bit undervalued at this time. In fact, last year at this time, we were at 326 in the nearby copper contract. So we're tight. And the market is going forward. Here's this chart's a little bit out of order here, but this is the hog chart. Again, if that reduction in the hog herd takes place of 16%, the rest of the world's going to have to really step up to provide that pork. The positioning in the hogs. Again, here's your speculative positioning. This is commodity index traders. They don't really have an overly significant position right now, but if you look at where the market has gone to, we've seen a dramatic recovery in hog prices of late. But the point of this chart is that as of February 12th, they were net long 65,000 contracts. But if this is one of the bigger stories of the past couple decades with what's going on in China, we could probably see a doubling of the index long in hogs. So if it was a topical headline story, hog prices begin to show significant reaction to scarcity of supply. There's a lot of speculative contracts that could come into play in hogs, and that's why some analysts have some fairly lofty price projections for hogs later this year. Getting into the interest rate markets, again, I might have a little disclaimer here because I'm extremely bearish toward treasuries, meaning higher yields. Just throwing out another one of those large statistics that some forecasting agencies are noting that at the current pace, the amount of interest paid on the debt will surpass the other largest item in our budget, which is defense spending, and that could happen within 5 years. And if the political wins to provide Medicaid for all, to provide free college for all, and to provide other benefits, could launch the deficit into significant stratosphere. And so one has to wonder what happens with these large buyers. Will they continue to take down that kind of supply of U.S. treasuries? So here's the holdings of foreign holdings of U.S. Treasury securities. So we see China and Japan. They are the main stalwart players. The question is, are we at an inflection point where China may begin to want to hold its own debt, may want to bring some of that money home to pay down their debt domestically for municipalities and other provincial sources. And perhaps the most important thing is if we do get to a situation where we see the slightest whiff of inflation, pulling out some of that money and merely halting the amount of purchasing could have a quite massive impact on prices. So you can see from the text box here, the box, that we did have a sharp decline in the first 10 months of 2018. Again, what you have to wonder, was that the result of the trade conflict, or was that the beginning of a major trend? But keep in mind that treasury prices at these treasuries at these price levels can require significant downward price action just to factor in a 1/4 to 1/2% interest rate hike. So don't underestimate the volatility and the potential downside action that you could see in treasury prices ahead. So that's my view. I think the economy is going to hold together. We're going to avoid a recession. I see a lot of fairly solid physical commodity demand. That's where I draw my economic views from. Don't do what China says, but see what China does. If energy prices have managed to return to $60 in the face of significant supply capacity, then we must be using the oil throughout the world, and therefore the economy is holding together. So in the commodities, I believe the platinum may begin to gain on palladium, that silver may later this year begin to gain on the gold market. And I think that soybean oil may be having a surprising demand lift, whether it's from biodiesel or just a reduced amount of palm oil available for the world edible oils consumption. So with that said, Cynthia, I would like to answer some questions here. I have not, I don't see them yet in the window, but I'm open to any commodity market that's actively traded. If I don't know, I will tell you that I don't know, but please, any questions or comments on any of the markets?
Okay, Dave, there are a couple of questions that did come into that questions panel. If you can find that over in your control panel, and then simply double click to open up that questions panel. It may have collapsed during your presentation.
Okay. I do not. You may have to read that.
Okay. Well, let me go ahead. And now the first question that came in was from Nick, and he's asking, why couldn't you just go short and buy put options if the commodities are going down instead of hoping they go up?
Restate that. That seems a little bit countervailing there.
Okay. He's asking about why wouldn't you just go short or either buy put options if you think the commodities are going down?
Well, I hope I've not given off the wrong impression, but I think that commodities are close to being done going down, and I'm looking for signs that we may begin to shift up, particularly in specific commodities I've talked about, gold, bean oil, etc. But you know, I'm a big proponent of using options, and I would strongly recommend that traders learn about options and the put options, and instead of being short futures, being long a couple puts. I even like that more. I like if I can achieve a little bit of leverage with respect to puts versus short futures. I really like that type of strategy can help you in extremely volatile markets.
Okay, next question is, do you pay attention to shipping indexes?
Yeah, the shipping index, the Baltic Freight Index, probably becomes even more important going into the future because of where it's located. Still not as important as the Asian, Southeast Asia, China situation. So indicators from there might be equally important. So yeah, I do. It's a big picture thing, and it can kind of be seen as a slow moving indicator. But I think it is very important. It's something that should be watched.
Okay, next question we have is, do you have any view on the coffee market?
Well, the coffee market, I would say that we have seen a major change in the coffee market over the past 4 or 5 years, in which Vietnam was not necessarily a player, and now they've become a player in which they have put out some very high quality coffee. And the last thing we needed in the coffee market was another supplier. And as you can see, prices have virtually caved in. And if I go look at the positioning reports in the coffee market, as would be expected, the market's net spec short 54,000 contracts in the most recent report. So again, here's one of those conditions where I think the market's factored in a tremendous amount of negative information, and here's a situation where call options are probably preferable to being long futures, because we do have a lot of supply. But keep in mind, we want to watch to see if there is an El Nino impact when it comes to those soft commodity markets. And for South America, keep in mind that the most likely occurrence of a freeze, the freeze dates, we get into July, and that's the beginning of where we need to be watchful of that. So El Nino / freeze dates in South America. So I guess I would be inclined to be a buyer of something like July or later call options in the coffee area.
Okay, here's another question. What was that about the worm in Vietnam capable of attacking cotton and other grains?
Yeah, what we see is they're called army bugs, and they prefer corn, but we have seen actually it started in in India is where we saw the initial flare up, and it's already had a significant impact there, and it's somewhat difficult to control. And we're picking it up in other isolated areas in Southeast Asia. So not a big issue. But again, as an analyst, I got to be making sure that I'm watching those kind of developments.
Okay, we have another question here from Melissa on your thoughts on the live cattle, given the flooding situation going on in Nebraska and Iowa, those feed yard regions.
Well, the feed regions, the problem we have in the cattle is that we're so good at what we do that it's tough to end up having a problem with production. And I might add in there, if we do see sky high pork prices in China, we're already starting to see record imports of beef into China. that this could be like the Fishmeal thing. This could be one of those major inflection points where a country that's historically not eaten a lot of beef could begin to eat a lot of beef. If you see sky-high pork prices, why wouldn't you begin to import some beef? And we've had a nearly complete shutdown when it comes to U.S. exports of beef to China, and a revitalization of that probably provides a demand element that will continue to lift cattle price. So I think a little bit of the price rally that we've had over the past 2 weeks is the result of that flooding. But I also think there's some demand hope that's mixed into the equation, and this comparative meat type of relationship between pork and cattle could leave the cattle market in an uptrend.
Okay, another question that came in: why is palladium worth so much more than platinum and even more than gold?
I don't know. No, I don't know for sure, but I think I have a good idea, and that is number one. And the market may be sending signals of something else on this. The number one in my mind is that you do have the potential for sanctions against Russia, where a very narrowly produced mineral metal like palladium is concentrated in that country. And so if we do the threat of seeing that supply held hostage inside the country has got the palladium market very sensitive. Now, if you have a strong demand function, like the electric vehicles, catalytic converters, China pushing for clean air, that's the backbone of the bull market. But the condition that ignited this record run is the situation in Russia, and so we have to be watchful. It's the rotation from palladium to platinum. Talking to the car company executives, it takes about 1.5 to 2 years. So that I don't believe that's probably lifting palladium, because you can't stop using palladium yet. And again, if you look at the total cost of the PGMs in a vehicle, you're talking wholesale, maybe only $600-700. So it's not really a problem for the car makers. They just add that on to the top. So it's a small metal with a little bit of a small production capacity metal mixed in with the potential for a earth-shattering supply disruption if sanctions against Russia are clamped down. Again, I think Citigroup and some other entities have been out indicating that platinum may now begin to get the investment flow, and ETF investment in platinum jumped up, and I think we reached up to the highest level now since October of 2017. And we do have that major electric utility in South Africa having rolling brownouts and blackouts. And so if they cut off power to the platinum mining operations there, then the second stage might be a strong platinum catch-up rally. So it's industrial, and gold's not seeing that definitive safe haven inflow of capital. Gold's behaving more like a physical industrial commodity.
Okay, thanks, Dave. If you were a farmer in the U.S., do you advocate planting corn or soybeans this spring in 2019?
Well, I'm obviously the overhang of soybean supply is scary. Corn planting can take more cost, and so that's sometimes scary. However, I think the corn market, it's tighter. We have the backdrop. A lot of farmers are comforted by the fact there's a lot of ethanol production in this country, and so they kind of got demand in their own backyard. If I just look at the statistics on how much corn we may or may not have, I'm just more confident in the corn market making some upside gains relative to soybeans.
Okay, to the next question is, if there is a downtrend in the stock market, what is your forecast for the commodity markets?
Well, that's a good question. And there's a difference between a downtrend in the stock market and a not a panic, but just a moderately negative / anxiety ridden type of situation. So if you have a casual downtrend, which I would think that's what the case would be. It would be a disappointing earnings type of forward look. But you can't predict. I mean, if there's some major geopolitical issue and we go down hard in the stock market, then the commodities are going to be dragged down with it. But we've had the longest underperformance of commodities relative to equities in history, in modern history at least. And so in a slow, casual erosion of equities, it would not be surprising to see some of this fund money shift into the commodity markets that are attractive. And so they'd have to be selective. But I think commodities, in particular, some markets would hold up and maybe even rally.
Okay. Enrico has a question here. How do you assess fundamentals for crude oil prices? Is there an accurate one?
Well, we do get statistics just a couple hours ago from the EIA. We get the International Energy Agency statistics on a very frequent basis and the API readings. And so, a lot of availability of the actual supply and demand that's going on in the marketplace. And so that kind of sets the general trend. I'm a classic fundamental analyst. The wild card comes down to what's the posture of OPEC, because Saudi Arabia in the last month and a half has been throwing itself in front of the train, so to speak, by reducing their own output and really orchestrating the $15 rally that's taken place in the crude oil market. So if the economy's holding together, energy demand is going to be strong. Even during very tense economic times, energy demand remains strong. During the subprime crisis, they thought we were going to see the first net annual energy demand decline since I think like 1940. But instead, we saw a global gain of 0.9% expansion in demand. So it takes horrific economic psychology to really crimp demand. And again, it's all about Asia. And look at what China's record refinery runs and record imports of crude oil. And so I'm of the camp that I think we can continue to creep higher in crude oil, and Citigroup's $70 target may be a little lofty, but I do think that we have more upside in crude oil ahead.
Okay, and now for the final question here. Antonio asked if you could give us a brief analysis on wheat.
Well, the wheat market is now, the center of the universe has now shifted to Eastern Europe and the Black Sea, which is why the CME has started a new Black Sea wheat contract. And so that the ability of Russia to produce too much wheat is a problem for wheat prices. However, we did have some problems in the U.S. We are expected to see the lowest wheat seedings in the U.S. in over 100 years. Logically, production of wheat in Australia is falling because they're the highest cost producer in the world. The question becomes, have we fully factored in an unrelenting supply from Russia? And are these prices below $4.50 a key low? And I think that we are now at the end of a long chain of bearish psychology. We've accepted big production going forward. And if you do see corn prices going north and wheat prices going south, we could get into a situation where we do begin to see a reemergence of wheat used for feed. So we are not as bullish toward wheat as we are corn, but we're certainly more bullish toward wheat than we are soybeans. So again, this is a situation where maybe call options are preferable to long futures.
Terrific information, Dave, and your insights. Thank you very much for sharing. Now, I'd also like to take just a moment, because we are nearing the end of today's session, to show you where you can access the Hightower report from the Interactive Brokers platform. Now, what I'm going to do, first of all, let me grab the controls back. And what I'd like to do is open up or show you my Trader Workstation. You'll see it appearing on your screen. And notice here that underneath the New Window button, you'll find access to Analyst Research. And notice over on the right-hand side is where you can locate the Hightower report. If you do hold a subscription or even a free trial period, you can access these reports directly from your Trader Workstation. Now, also do want to point out for you, we do have information or additional information available on our website. If you go underneath the pricing menu here, you'll find research news, a research and news section. From the top of the section, if you enter the Hightower or simply do a find, you'll find access to the Hightower report as well as those monthly subscription fees. Notice here we do have a free 30-day trial period for these subscriptions. So if you would like to take a look, notice that that 30-day trial period will begin as soon as you do or make that request. Now, requests for the subscription or the free trial need to be made through the account management platform. Underneath settings, you'll find user settings where you can find the Hightower report and subscribe to those. Now, notice that on this page here, you'll find a description of what's included. You can learn more, and it's available on the Trader Workstation. I'm going to click through that Learn More button, and notice here you can find information and even view sample daily reports, as well as the weekly market letter report samples are also available, including a link to the website. So I do encourage you to take a look at what is offered through Interactive Brokers. But at this point, what we are going to do is conclude today's webinar. Much thanks to David Hightower for his presentation today. I also want to thank all of you for participating in our webinar. By the way, we have been recording today's event, and each of you will get a direct link to today's recorded playback, as well as the slides that Dave was using for the presentation. They'll be mailed directly to you with our follow-up message later on this afternoon. So do watch your inbox. So with that, we are going to conclude the session today. And once again, thanks very much to David Hightower of the Hightower Report for his insights he shared with us here today. You can all exit today's session using the X in the upper right-hand corner of your screen. Have a great rest of your day, everyone, and thanks so much.